Hello, my dear friends. This is CA Chinmaya Hegde, your learning partner in CA Final SFM Strategic Financial Management. The objective of this video is to understand some practical aspects of the concepts what you are reading in SFM for examination. Even in class, our main area focus was to understand from the practical point of view and theoretical point of view, but more mainly it was focused on examination, right? So this time, what we are going to do now is understanding the concept. At the same time, let us test it practically to the extent possible. So we will take one measure after the another measure. I will be taking now the concept of beta. Okay, now as you know, beta means the rate of changing one variable with respect to the rate of changing another variable. Okay, hang on before we go further. So what we're going to do this in this video and going further, quite a few other videos which follows this. We will understand about the theoretical aspects like beta here, little bit about the formula, and I'll not solve the problem from exam point of view. I will not do that. Instead, I will focus on practical aspects. So in the class, whichever way you would have attended, definitely you would have seen so many formulas for exam point of view, tabular presentation, all those things you would have done. Now let us look into some practical aspects. So I will take the data on some companies, share price, I'll tell you which website you can use, and I've done it in Excel, all the calculations, and we'll present it into you. We'll calculate, we'll understand, we'll all analyze, and we'll test whether it applies in practical life or not. Fine. So let's go to beta. Basic formula you know already. Beta means is formula wise, let me write it to you. That is change in market return divided by change in change in security return by change in market return. Market return is always in denominator. Always market will come in denominator. So many formulas are there. I'm going to discuss quite a few now. But keep the basic rule in mind. Market will always come in denominator. Fine. This is one formula you know. Other two formulas also will come to it. Many others are there. So basically what is beta? You compare two variables. If one variable change, by how much another variable will change. So we can also say like a sensitivity. Sensitivity. I've given a lot of examples in classes. I'm not going to that aspect. But if one variable changes, how the other variable will behave, the reaction, the response, the sensitivity between two variables is called as beta. You see what is happening due to coronavirus? Suppose if it comes to one person's body, some person can be affected most, and some person may not be affected, and some person may be mildly affected. You know there are various cases: not affected, mildly affected, severely affected, and maybe death also. You can say that is an example of sensitivity. That is low sensitive, high sensitive, medium sensitive, and so on. Same thing applies to stock market, and that is when the market changes, the macro factors changes, like this situation what is happening due to coronavirus or any other situation for that matter. when the market changes, when the index changes, how the security will behave, how the portfolio will behave. That is what is called as beta. This is the formula. So for example, if I say beta is 2, that means if the market benchmarks moves by 1%, then the security or the portfolio is likely to move by 2%. So 1% up market, 2% up security. 1% down market, 2% down security. So the movement on upper side is also higher, movement on downside is also higher. That is why beta also is a measure of risk. To be specific, it is a measure of systematic risk. Sorry. Yeah. So to be specific, beta is a measure of systematic risk. What is systematic risk, unsystematic risk? I'm not going to discuss towards that because that is a different area again. So beta is nothing but when one variable, that is to be specific, when the market changes, how the security will respond as compared to market is called as beta. So what are the other formulas we have? Basic formula we have seen now. Other formula popular is uh, this is the short form beta R into standard deviation of security by standard deviation of market is 1. Another covariance by market variance. Observe here also market is in denominator. Okay. Now I'm not going to solve the problem from exam point of view. Instead, let me take some practical aspects. So I've done it for you. Take a look at this. So I have taken Nifty 50 as the market. So you can see I'm highlighting here. Yeah, highlighted in yellow there. So Nifty 50, I've taken it as a market and I've computed about some 25 companies. And I've calculated beta for every year. So I've computed for 25 companies. I'll show you as an example how to compute for one of the companies. Then I will go into the analysis. Okay, these are the betas computed for the year 2016, 2017, 2018, 2019, and the year just ended 31st March 2020. Then I take an average also. You can see so many numbers are visible. But before going to that, what I've done is yearly beta calculation. So let me take an example for one company, how I have calculated. Like that, you can also calculate yourself. Let me show you the calculation first, then I'll do the analysis. Then you can test yourself whether these things are correct or not. Are you ready? Let's go further. Okay, so take a look at this. I have taken monthly share prices from the year 2015 till 16, 17, 18, 19, 20, 31st March 2020. Till that I've taken the prices for Nifty. Nifty is the market, right? And this Reliance Industry is the security. Now, where did I get this data from? Very simple. NAC India website is there. BSC India website is there. Various other websites like Money Control is there. I have taken data from Yahoo Finance. So you can go to the Yahoo Finance website. Historical price tab will be there. You can just click on Excel download. It will be downloaded. But only thing is you have to download company by company. I have downloaded 25 times. No restriction. It's free. Anybody can go to website and download it. So I've taken the market as Nifty 50 and one stock Reliance Industries. Fine. Okay. Now take a look at this. 31st March 15, April 15 and all, the prices are there. But before we go to the beta, we need returns. because beta is about the returns provided by the security as compared with the market. So prices are downloaded from the website, and what you require now is the returns, which I'm doing it now. Take a look at this. So I'll have one column market and one column security. Do you know, my dear friends, how do you compute return? Current price minus previous price divided by previous price minus 1. So let me do that now here. Excel formula I can easily give. So market current price minus previous price divided by previous price. So B4 minus B3 by B3, current price minus previous price divided by previous price. Then even for Reliance Industry, I don't have to calculate again. Excel will tell you. Just drag the formula, the copy paste will happen. Then you don't have to put the formula once more. You just drag the formula down. All the returns are calculated. You see, all the monthly returns are calculated. So 3.65 minus 3.65 is for the month of April 2015. 3.08 is the return for the month of May 2015. Like that, every month return is calculated automatically in Excel. Practically, for exam, you have to do so much. But practically, this is how we can compute the return easily. Now, what is the formula for beta? I told you. First, you need to calculate R. So I'm calculating what the data sheet I have is for every year. I'm calculating separately. So 2016 separate calculation, 17 separate calculation, 18 separate calculation, 19 separate calculation. So I'll show you for 1 year only. Like that, you should do it for every year. Okay. So 31st March 15 till when the year end will happen, 31st March 2016. So 1 year. So you will have 12 returns, monthly returns, right? So 12 returns are there. I'm highlighting in yellow. Okay, correlation formula is there. Covariance by standard deviation of S into standard deviation of market. No issue. You can use a formula called as correlation. CORREL, correlation. Select the market return, monthly returns, then select the security returns. It is done. So this is the correlation, which is R. Then what we require? Standard deviation of security, then standard deviation of market. In this case, standard deviation of security means the Reliance 12 months monthly returns. Select it. I got the number. And then standard deviation of the market. Formula is there. Standard deviation dot P. Select the market returns. So this data is also computed. Now what is the thing? You have to calculate beta. So equals to, what is the formula? R into standard deviation of security divided by standard deviation of market. That will give you 0.87. Now if I go to the company Reliance Industries, somewhere up there, yeah, Reliance Industries, you see here Reliance Industries, first year I have done 0.87. Hope you got how it is to calculate. Actually, I'll tell you one more easier method, a faster method to calculate. We don't require these three things. I tell you so that you remember as a revision, for example, for exam purpose. For what we do actually is, in Excel, there's one formula called as slope. Beta is nothing but a slope in a straight line. Y equal to mx plus c is the general form of a straight line equation, linear equation, that m stands for slope, rate of change in one variable with respect to rate of change in another variable. Anyway, don't worry. So slope, select the security returns, then select the market returns, you get 0.87. So I've calculated 0.87. This is one data point. I've calculated that for 25 companies for these many years, just to tell you how the beta will happen over a period of time. So I showed you how to do for one company. I'm sure you can try it for other companies as well. So hope you understood the basics of beta. What does beta will reflect? How to calculate data? how to download the data, which are the website available, and using the Excel, how to calculate beta for a particular year, for a particular security. So I hope you will also try out many more based on this. So let us come to the analysis part of it now. So this is actually is what there for examination purpose. Now what I'm going now is one step further. Look at these beta points. Let's say Reliance Industries, what is highlighted here. 2016 it is 0.87. 2017 0.75, 1.63, 1.59, 0.83, 1.13. That is an average. That is to tell you beta is not a fixed number. You can't say that, okay, beta calculated, this will remain for lifetime. No, it is not like that. It is a fluctuating number. It is a statistics, my dear friend. It's just an average. Many statistical parameters are there. One of them is beta. And as you take different data points, beta will change. So beta, that is why you have to understand practically, is beta a measure of risk? Yes. Is it a fixed number? No. Every year, every data point, the beta is going to have a different number. As you can see here, Reliance Industries got 0.87, 0.75, 1.63, 1.59, 0.83. Okay, fine. So I've calculated like this for many stocks. Let us come to the analysis part now. So let me just hide for the time being. Let me just focus only on 31st March 2016. So don't worry about this Nifty 50. That cannot have any value. Don't worry about it. Now come to this. Jindal Steel has got 1.89. Means if the Nifty 50 changes by 1%, then the Jindal Steel prices will move by 1.89. Higher sensitivity, higher risk, higher return also, but higher risk also. So Diwan Housing Finance 2.27 times. Punjab National Bank 1.59 times. India Cements 2.49 times. BHEL 2.86 times. Your favorite PVR 1.02 times. SDFC Bank 1.05 times. TCS one time. What do you mean by one beta? The market return and security return are moving in same proportion, equal sensitivity. That is what is beta equal to 1. You see Sun Pharma Industries, negative beta, which means they move in opposite direction. Mindtree is negative beta, CA Tires 0.38, 0.46, 0.93. So you see these numbers which are more than 1.8, 2.2, more than 1. You know what is the meaning of it? Beta more than 1 means the market return 1% and security return is more than that. When the movement is faster, when the risk is faster, the beta will be more than 1. So repeat once more, when the beta is equal to 1, that means security return and market return are moving in same proportion, whereas when beta is more than 1, that means the movement of the security is faster. And what do you mean by the movement of the security is faster? That means the risk is high. So these stocks, as you can see here, which have got the beta more than 1, are riskier than market, whereas TCS 1, that means TCS is same risk as market, whereas Infosys 0.89, Gillette India 0.46, Colgate 0.38, less than 1. Beta less than 1 means the movement of these securities are slower, lesser than market. So risk is also lesser than market. Beta more than 1, higher movement, higher risk, higher return. Beta less than 1, lower risk, lower movement, lower returns. Hope you are getting this point. The direction is given by plus or minus. and the proportion is given by the actual values. And this negative beta minus 0.10 minus 0.122 means when the market increases, the security will go down. So negative beta means security and market are moving in opposite direction. Okay, so you look at these companies now. Wherever the beta is more than 1, look at the names of the companies. Jindal Steel, Diwan Housing Finance, Punjab National Bank, India Cements, BHEL, Soba Developers, State Bank of India, Maruti Suzuki, and yeah, Nestle India is fine. Okay, so these stocks, if you closely observe, they are banking stocks, non-banking financial companies, cement companies, Jindal Steel Company, Construction Soba. You see, understand? Stocks into infrastructure are likely to have a higher risk because the sector itself is like that. Real estate sector, cement sector, the construction sector, the banking sector, they are by default high risky sectors in general. That's why you see these stocks are having higher beta. But also observe, HDFC Bank is also into financial sector, which means the State Bank of India has got 1.76 beta, high risk. HDFC Bank is also into financial sector, 1.05, low risk. Those are the good stock to buy, in my opinion. So they are belonging to uh, risky sectors, but they're having lower betas. In a risky sector, less risk. Good pick. Okay, so don't buy HDFC Bank because I told you. I'm just trying to give an example of the beta to be analyzed in a practical manner. Look at TCS has got exact one. You see Nestle India. You see these companies, Infosys 0.89, C8, Colgate, Gillette. Okay, let's example Gillette and Colgate. They're having very less beta. Why? Colgate and Gillette is having less beta because when the market moves, Colgate, Gillette will not move much. Of course, they do move, but not much. For example, there is a lockdown due to coronavirus. That means you're not going to do much of banking business. Banking stock will fall. You don't travel much. Aviation stock will fall. You don't go for construction. You're in home only. Those stocks also will fall. But you don't stop brushing every day. You will not be like, oh, you today coronavirus may come. I will not brush it. I will not go for brush today. People who don't brush, they don't do anyways. You understand my point? These stocks, Colgate, Nestle, Gillette, means these stocks will always have a demand. These sectors are called as consumer sectors. They don't give higher returns and they don't go down also. Even ITC is one of them. Yeah, ITC is also 0.78. You see, that is also one of them. ITC is one of the popular product. Anyway, so the point I'm trying to tell here is the beta reflect risk. The company's risk is there, but you should also be able to analyze that sectors by default, by their nature, are high risky sectors. They will have higher beta, and some sectors like consumer sectors, by default, by nature, they are low risky sector. They will have lesser betas. So in the less risky sectors, you should look at high beta. That will give you higher return. In the high beta sectors, you choose lower beta. That is more consistent. You understand how you can play with the beta game when you're choosing the stocks. There are many more things, but this is one of the way of analyzing beta into practical aspects. Hope you are with me now. So this is the beta for the year 2016. But at the same time, remember, once you construct your portfolio, just give me a second. This not required. Okay. Now, once you construct your portfolio, say high beta stock, low beta stock, don't just invest forever. You have to keep reviewing your portfolio, maybe every year or every some event happens. You should review. Check whether the portfolio is in balance or not. Please observe Punjab National Bank, for example. Fine. It was 1.59, little riskier than market. 1.41 in that range. 4.6 suddenly return. 4.6 higher risk. Things have changed. You understand, my dear friends, what is really happening over there? Let's say we take one more. Okay, look at the TCS. TCS, we thought that it will have same risk as that market. Next year, 0.455, 1.48, 0.88. You see, it is increasing, decreasing 0.37, 0.86 also. In 1 year, it has not given enough returns. So the point is, my dear friends, beta is a very good measure of risk, but it keeps fluctuating. It's not a fixed number. It is just an indicator of what happened in the past. So it might happen in the future. You cannot say it will happen. But in exam, if no other information is there, we have to assume it will happen. That is the basic assumption of any analysis. The history is the indicator of future. The beta is a measure of risk. What happened, so it is likely to happen in future. But that's why I'm showing it to you for these companies that beta will not remain same. What is low beta in 1 year might be high beta another year. Look at this Divan Housing Finance 2.323. High beta, suddenly it became 0.77 low beta. Next year 3.95 high beta, next year 0.54 low beta, and so on. Okay, so this is one of the ways of analyzing the beta into practical aspects. So today we discussed about the meaning of beta and some basic formulas and examples of betas for certain companies, and how do they play a role in certain sectors, and how do they keep fluctuating over a period of time. You see, India Cements, it was positive number, it became negative number also. Look at this negative beta. So that is how beta is a good measure of risk, but it is not a foolproof thing. It is only an indicator of what happened and therefore what is likely to happen. It requires a frequent check to verify whether beta is intact or it is undergoing any changes, because based on beta there are many more other strategies also. In index futures, hedging will be done using beta. So if beta changes, your hedging strategy also should change. So that is the practical aspect of application of beta into certain companies and into certain sectors. So if you want any other uh, a topic to be discussed practically, please uh, reply to this. Maybe I'll share my mobile number and my email ID. Okay. So here is my mobile number, email ID, and my Telegram channel also if you want to go for more updates. So like this, I'll be keep coming up with many more practical aspects where we're linking the topics in your CA final SFM syllabus into the practical data points, and of course using Excel. So like this, if you want any other topic to be addressed practically, please have your message down to this mobile number, email ID, or please join my Telegram channel. So thank you so much for listening to me for past 20-30 minutes. Happy learning, happy investing. Thank you so much. Bye bye.